Good morning, good afternoon, and good evening, folks. I hope all of you are well. And if you can hear me loud and clear, and you can also see my screen, please do give me a sound check by saying yes. Or if you can't see my screen, if you cannot hear me, please say no. Thank you, Leslie. Hello, Philip. Good to see you over here as well. Hello, Laura. Good to see you over here. For those of you who already know me, my name is, sorry, for those of you who already know me, you know me. And for those who don't know me, my name is Naeem Aslam. I work as a chief market analyst for AvaTrade. I come with a wealth of 15 years of trading experience. During this time period, I have worked as a hedge fund trader for Bank of New York Mellon and as an equity trader with Bank of America. So welcome once again to our weekly webinar. And in today's special segment, we'll be covering indices. This comes at an important time. Why? Because the market is in a complete sell-off mode. Traders are wondering and confused what to do with the markets, where the markets are going to go, where is the low for this particular market, or if we are going to see a rally for this equity market. Because this week we have certainly seen mammoth amount of volatility coming into the market. And of course, it's not only this week, the trend has been going on for the last number of weeks. So we will look at a number of things in this particular webinar. We will, of course, analyze the market, but at the same time, I wanted to make sure for those of you who have joined us for the very first time, we give you some basic information. What are indices? Why do you trade them? What are the benefits of them? And how you can use indices more efficiently. So Roshin is saying, I can't see your screen. Everyone else, I think it's just with you, I think. The issue is because everyone else, they can see my screen. Yeah, just a small bit of an announcement that this particular, because I am based in London, but this week I am based in Dubai. I am here for the Forex Expo. And if any of you is in Dubai, please do come to say hello. The conference is taking place in the World Trade Center, and we are in hall number 6, Zabil hall number 6. So if you are in Dubai, so please do let us know. Thank you, Philip. So Philip has just confirmed, and a few others have confirmed that they can see our screen and everything is good. Right. Now, as always, first things first, and which is the risk warnings and disclaimers. Anything we shall be discussing in this particular video cannot be perceived as an advice. If you are looking for one, please do consider consulting with your own financial advisors. Now, the contact details are in front of you. Please feel free to get in touch. The recording of this particular session will be uploaded on our YouTube session, so you can always get on that and see the recording. And I do wanted to alert you and wanted to apologize in advance for a bit of a noise at the back, because I am at the conference center today and really kind of doing my best to reduce the background noise for you guys. So something that I wanted to discuss about the unique technology over here, and that is the AvaProtect. It's a revolutionary one-click risk management tool. available on the AvaTrade web trader and of course the AvaTrade Go app. With AvaProtect, you can purchase protection against loss for a defined period after opening a position. If the protection ends and you have an open position that is losing, of course, AvaTrade will reimburse the loss directly into your account, into your trading accounts. The only cost will be AvaProtect fee itself. If you do have any questions for the right reason, for whatever reason, please do get in touch with your own account managers who will be very happy to help you with that. Now, the next part of this presentation is obviously for those traders who are very much new in the game, and then we wanted to walk you guys through with few questions, few study questions. And what I want is I want our regulars to help us with those study questions, because by you answering these questions, it will be you reinforcing the concept within yourselves or within your mind that you understand very clearly what are the opportunities and why you should be trading. So number one, so to begin with the first one, why to trade indices? What is the reason that we trade indices? Can anyone answer that particular question? Philip, to answer your question, AvaProtect is not a different app. It's a function which sits on the AvaTrade Go app. So Amutha, good to see you. So there is a momentum as in big movements, and with volatility, there are opportunities. So what Amutha is basically trying to say in a very simple English is that indices are good if you love volatility. It's not that we don't have enough volatility for the last few weeks, but overall, traders, especially day traders, swing traders, they prefer indices because they have bigger room to the upside or to the downside, or shall we say, the daily momentum, the daily movement is relatively larger than a stock, than any particular stock. So that's why they like them. Second of all, the reason that you wanted to trade indices is because it gives you diversification across a number of stocks. What do we mean by that? If you have $1,000 in your account, you can only buy so many of Google or Apple shares or Amazon, if that. But by buying NASDAQ or by buying S&P 500 or your Dow Jones Industrial Average, you have an exposure to all of those stocks which are part of that index. So for the Dow Jones 30, you have an exposure for top 30 industrial stock which are listed or which are part of that Dow Jones. For NASDAQ, you have an exposure to top 100 stocks which form the NASDAQ 100. Similarly, for the S&P 500 index, you have an exposure to the top 500 US companies. So by buying one particular instrument, you are actually having exposure to all of those companies. That is the key reason that I really, really like, because obviously with the smaller accounts, with a $20,000 or $30,000 even account, you cannot possibly have everything in your portfolio. But when you trade indices, you do. Now, of course, if we come to the European side, you have the DAX, which is your German stock index. You have CAC, which is your French. You have IBEX, and of course, Stock 600, Stock 50, UK 100, which is also known as the FTSE 100 index. So by buying these stock indices, you are actually having an exposure to all the groups of the stocks which are part of that particular index. So Alina has made a very interesting comment because an index cannot go bankrupt. So it's a very, very interesting comment that she has made. So a company, one company can certainly go bankrupt, two companies can go bankrupt, but the chances of 30 or 500 or 100 companies going bankrupt at the same time, the chances are very minimal, or the odds are not stacked in favor of that particular event happening. So Elena, well done to point that out for sure. Thomas is also making a great comment over here, which is indices provide high quality and average out movement of single stocks. So basically, in plain English, what he's saying is there is plenty of liquidity, meaning you can get in and get out with a very little, if any, slippage, because usually on the stocks, if you are placing a order to buy 100 or 200 or 500 or 1,000 stocks, you are bound to get some slippage, or the price isn't really going to be that great. In terms of indices, there is ample liquidity on the market, and you won't get that much of slippage in terms of that. Now let's move on to the next one, which is the inverse of indices. So inverse of indices is really an idea which is talking about the volatility index, which is known as the VIX index. Now, I'm sure that those of you who are in the market for some particular time, you know one thing very, very clearly. So on one hand, we have the US 500 index, okay? Let me put that over here. So this is your S&P 500 index on this side. This is your volatility index. This goes up when markets fall. This goes down when markets go up. So they have very different relations. The relationship among them is completely on the opposite side, because when this goes up, this comes down. When this goes up, this goes down. And that signifies the importance of the inverse of this particular index, or the volatility index, because this really tells you in detail that there is no time for a day trader to sit on his hand, because the opportunities are there if he or she wants to take it. Because when markets are falling, you can buy the volatility index and can still be in the trade. That is only if you don't want to short the market. When markets are going up, obviously you wanted to buy that at the time. Most of the traders would buy that, so that's great. But if you don't believe that, you could short it, because when this will go down, this is going to go up. So the relationship between the two is quite opposite, and usually when this volatility index is at its peak or near its peak in comparison to its previous levels, it is an indication, an early indication, that the stock index, which is falling like a rock, and it does like that, when the volatility index makes its peak or is near its peak, this is generally an indication that now the trend is going to reverse, and we will see the equity market moving to the upside. Of course, we will see live examples of that. And now we move to the next agenda, which is about obviously defining levels and defining a strategy. We will do that live in the market by showing you the charts and nothing else. But does that make sense so far, what we have covered? Because it is important for me that the foundation levels have been set, so that when we move on to the actual trading floor, or to the actual trading platform, you guys are very much with me in relation to that. And remember There is never, ever anything like a stupid question or a bad question. Every single question is a valid question. Take this opportunity to ask me questions today, or you can always get in touch with me on Twitter, where I am quite active as well. So let's look at that. What is going on in the market? Well, the market has started to fall off a cliff. What do we mean by that? It formed an all-time high in this particular point, and after that, it fell, came into this area, and then we did see a small rally, which came into this area. However, this rally failed to continue its momentum, and now the market is moving back to the downside, moving lower once again. Nonetheless, there's something important for us to look at, which is as follows. Firstly, we have these three important lines on this particular chart, which I wanted to explain it to you guys. This over here is your 50-day, 50-week moving average. This is your 100-week simple moving average. This is your 200-week simple moving average. Generally speaking, when the market falls near its 50 or 100, it is a good opportunity to buy. It is a good opportunity to buy when the market falls near its 50. It is a very good opportunity to buy when the market falls near 100. And it is an exceptional opportunity when the market falls near its 200-week simple moving average. It doesn't happen that often, because if you look at it since 2016 to 2021, there has been only and only one occasion when the market fell to its 200-week simple moving average. And when it did, what a rally we saw in the market. Now, there has been a few occasions when the market tested its 100-day simple moving average, as it did over here, and it violated it over here, and is possibly retesting that over here. Now, of course, over here there was a small bit of a violation, and after that we did see a rally, but this one was a complete violation as the market came close towards its 200-week moving average, and then we saw the massive rally. So overall, what we want to say over here really is that market is in a great place when it falls towards its moving averages. For the S&P, for the Nasdaq, the opportunity is coming. The opportunity is almost there, because it is this area of support that we are very much focused on over here. So this area from here to here is a great area where we can actually, if the market comes, we could potentially see that area as a demand area, as an area of support where the market can bounce back. Now, what about looking at the same time frame but looking at a different instrument, such as the S&P 500 index on the weekly time frame? Now, see the difference. Over here, we have moved quite a bit from its 50-week moving average. For the S&P 500 index, it's quite different. Why? Because we are still a little bit above the low of this particular week, or which was the low formed this particular year mostly. I mean, this is the low of this particular of 2021, but we are in 2022. So this is the low for this particular year, and we are still respecting the low which was formed over here. But with respect to the Nasdaq, we have violated that low. The market is moving to the downside, indicating to us that the Nasdaq is a weaker index. But as for the S&P 500 index, yes, it is a weaker index, but it's not as weak as the Nasdaq. So the chances are that when the market will rally, whenever that rally will happen, it can happen from this particular point. And as a trader, you could look at the stop level as the low of this particular candle, and then let the trade work itself out, and then see if you get stopped out, or either the market is going to be rallied. If it stops out, that's great, no worries. So that's a part of the business, that's a part of your cost which is involved. Then you will look at the next important support level, which is going to be here, or for those investors who don't like to play around too much, who likes to buy the market at important or at an extreme price levels, then for them it is just near where the 100-week simple moving average is, or over here. Now let's revise the levels for this one. For this one, what we're really looking at is these particular lows over here, and we are taking it, actually we are just taking it down all the way to here. Or alternatively, you can look at this particular low, this particular consolidation area as well. If the market comes in over here, we could potentially see market moving to the upside. Or if you can't stomach bigger risk, you can put your stop loss at the lows of this week for the Nasdaq and see if the trade works in your favor. If it doesn't, you wouldn't lose much. And if it works in your favor, you have plenty of room to cover or take profit. With respect to the S&P 500 index, you can try the low of this week and let the trade work itself. If it works, you have plenty of profit to take. If it doesn't, you have a very minimal loss to go for. Otherwise, we will go into this area. I would prefer this area because the RSI, which has two different levels, firstly 70, the second is 30. 70 is associated with overbought, meaning if RSI is anywhere near here, one should be selling it. The other one is associated at 30, which is as oversold. When it comes into this area, like it did over here, one should be looking to buy because the market is about to rally. So we are still a little bit far from reaching this particular level. This level can be achieved if the price fails to stay here, and if the price moves to the downside and it comes into this area of support. Now, what about the next one? And the next one is your Dow Jones Industrial Average. Where is your Dow Jones Industrial Average sitting? When we look at Dow Jones Industrial Average, we'll change the time frame to a weekly time frame. What we see with respect to the Dow Jones Industrial time frame, Dow Jones Industrial, is that we have our important support zone near its 100-day simple moving average. Again, this one looks pretty similar to the Nasdaq because it's trading quite away from its 50-week simple moving average, as you can see over here. But with respect to the S&P 500 index, it wasn't. In fact, it's back in the positive territory, and so is this one, and so is this one. Well, actually, not the Dow Jones Industrial Average, but nonetheless, the important point to note over here really is that if you wanted to buy this one, you may want to wait for the price to come over here. That would be a great price level to buy. If you can stomach more risk, and if you wanted to take more risk, then what you could do is place your bets at these particular levels. Now, from the fundamental side, what can drive the price to the downside or to the upside? Speaking fundamentally, what we have is we have two important factors. Can you guys guess what are those two important factors that are driving the markets? Great answers. So the answers of the people are saying there are two different factors. So let's just write them down over here. Number one is, of course, Russia and Ukraine situation. The geopolitical tension over here is very much the driver of this particular move. The second is the Fed. And with that, what we mean is the number of interest rate hikes the Federal Reserve is going to do this year. 5, 6, 7, you name the number, the Federal Reserve is looking at that, and then that is the number that everyone else is looking at. So if the Federal Reserve is going to increase the interest rate anytime, anywhere between 7 or 8, even we're going to see this one moving to the downside. If Russian tensions continue to escalate, we will continue to see this one moving to the downside. If this begins to come to the downside, meaning we see de-escalation of tensions, we could see the market moving either from here to the upside or from here to the upside. Both of these zones can happen, provided that we see any news or any situation which shows de-escalation of tensions. On the Fed side, if we see the Fed not showing their aggressive side, meaning less interest rate hikes, the market will rally on the back of those particular assumptions. So there we are in relation to these particular indices. Before we finish off, I wanted to quickly look at one more index, and that is your DAX index, because this is my favorite index right now. The DAX index has broken out of an important area of resist consolidation, which was this. So it was very much trading in around these particular levels. These were the highs, these were the lows, and overall this one, all of that was a consolidation area. But fairly recently, only a few days ago, it broke out of this particular consolidation zone, came into this area of support, violated it by a small bit, but then after that, we did see it a massive momentum in terms of the price action, which pushed the prices to the upside, and now we are seeing the continuation of that. If you wanted to see a little bit more analysis on that, head towards our YouTube channel, which has all the information on that. All right, guys, this is all the time that we have for today, but I promise to see you guys next time, same place, same time. Until then, stay safe and happy trading. Thank you so much.